Welcome to Every Dollar Counts with Josh and Jay, a shot of truth serum for your investment and insurance questions. I'm Josh Knoll, the owner of Gulf Coast Financial Advisors, and I'm joined by my co-host, Mr. Jay Stubbs, director of the Gulf Coast for Concourse Financial Group. We are brought to you on the Gulf Coast Financial Advisors Podcast Network. So, Jay, buddy, I think the world is aware, and certainly in America, that interest rates are rising.
They certainly are.
Yes. Now, this episode is not going to be about why the Fed is raising the Fed funds rate to combat inflation. That'll be an episode in the future. But more specifically, we're going to talk about things that are on the minds or should be on the minds for retirees and pre-retirees. And that is, what does the Fed's plan of raising rates, interest rates over the next several months, how does that impact any potential annuity purchases that they're looking at? And I think as we go through this in our pre-work, I think folks are going to be a little bit surprised. So, but before we dive into all that, let's have our friends from Sloth Racer kick us off. Jay, my friend, how you doing today?
Josh, doing well. Good to be here in studio at Deferred with Johnny and crew, enjoying some more recording sessions with you and putting out there for Every Dollar Counts and having our clients get some timely information, especially with respect to interest rates.
Right. And we don't timestamp our podcast. I don't think this will, but we're also hustling a little bit because apparently we got some weather coming in.
Do you also notice that we say that pretty much every episode?
We don't
timestamp it, but yet we mention something that's going on. I mean, it's just natural.
It is natural. That's right. Well, we try to give you all a picture of what it's like to be down here on the Gulf Coast. And if you go back in our catalog, we'll do some certain things where we actually talk about the lifestyle down here. And not that we need to encourage more people to move down here, but there's definitely some appeal. And then on the flip side, every now and then you get your butt kicked by Mother Nature, and you realize that this is part of the package. It's the price you pay to live in paradise. I think you say that. So, all right, Jay, quick housekeeping for compliance. Jay Stubbs and Concourse Financial Group are not affiliated with Prime Capital Investment Advisors, Qualified Plan Advisors, or Gulf Coast Financial Advisors. And me, Josh Knoll, I'm not affiliated with Concourse Financial Group. So, Jay, let's jump into our topic. We're going to break it into three parts. The broad term is, how do rising interest rates impact annuities? Now, that's a very broad statement and could go several different directions, but we're going to break it down into three parts. First, we're going to define what do we mean when we mention annuities. And listeners, for this particular episode, we're going to stay focused on fixed annuities. We'll explain what that means. Number two, we're going to talk about the correlation or the how pensions play into annuities and vice versa, which may surprise some of you pension holders. And then lastly, we're going to get into the meat of the topic is when we have rising interest rates, where we actually have at least somewhat of a schedule from the Fed that rates are going up. What does that do to your particular annuity that you're looking at purchasing, or maybe you already have purchased? So, Jay, first, I'm going to kick it to you. We're going to talk about the four broad types of fixed annuities. If you don't mind, let's start with one that most people recognize, a deferred income annuity.
Deferred income annuity says I'm going to put money into a vehicle, the annuity itself. At some point in the future, I'm going to draw income from that annuity. That annuity may or may not grow based upon how it's structured inside the annuity, but it just says I'm just not going to take income from this thing right now. I'm going to do it and defer the time frame that I draw that income from it. Depending upon the nature of the holding, it could be a non-qualified deferred income annuity. So that would be money that you take from your checking account or your savings account and you reposition into a non-qualified deferred income annuity versus a qualified plan or IRA deferred income annuity. Hey, I'm going to make a contribution to my IRA plan. I'm going to make a contribution into a deferred income annuity. At some point in the future, I'll draw income from that. And since it's a qualified plan, perhaps maybe I got a tax deduction on that contribution. And at some point down the road, when that income does come out, it may be a taxed situation. We're not going to get into how annuities are taxed today, just the interest rate component of it. But deferred income annuity, socking money away for future income need.
Very good. Some folks are familiar with our next type of annuity. The industry calls it a MYGA, multi-year guarantee annuity. Common general public may know it as a fixed rate annuity. But let's quickly talk about what is a MYGA and how it looks and tastes similar to maybe a bank CD.
Yeah. So your organization, our organizations, both of us represent lots of different companies that offer a MYGA or a multi-year guaranteed annuity. We can look at something as little as 1 year all the way out to as many as 10 years. And obviously with the word guarantee in there, we're looking at a guaranteed yield to surrender. So if somebody's talking about annuities and talking about a MYGA with a guarantee component in there, we have a guaranteed interest rate from the underlying insurance company that says if I put $1 in today, I'm going to get X amount of guaranteed yield to surrender. And those usually are rates that are tied to, obviously, Fed fund rates and, more importantly, the 10-year Treasury yield. But MYGAs in general are a specified period of time. Again, 1, 2, 3, 7, 10, and I'm going to sock my money away for that specified period of time. And at the end of that time frame, I know exactly how much money I will be walking away with because I know that my guaranteed yield to surrender has helped me accumulate more money than what I put in.
Very good. All right, third on our list will be a little bit of kind of a kissing cousin of the deferred income annuity. Let's talk about immediate income annuities briefly.
So an immediate income annuity, Josh, is where I need to draw income today. And I've got a large bucket of money that I want to start that income. Obviously, I could put it into a savings account, and current savings accounts rates are not too attractive, or I could put it into a CD, and I could just draw money out over time. However, an immediate annuity says, hey, insurance company, because you underwrite these products, we're going to give you X amount of dollars, and we want to start drawing a monthly income immediately, and I want to do that for a specified period of time. I can do that for 5 years of income. I can do it for 10 years of income. I can do it for a longer period. I can do even lifetime income. But you are getting an underlying guaranteed rate of return on your money you give the insurance company, and then they're giving you a guaranteed monthly or quarterly or annual income amount off of that balance. Typically, you will end up with more in your pocket than what you gave the insurance company in a SPIA or a single premium immediate annuity.
Right, time value of money. And then last thing, Jay, this one is a little bit more complex product, so we want to lightly touch on it because there are some moving parts to it. But a fixed index annuity for somebody that says, I like having this guaranteed income, but is there any potential if things do well where maybe I do a little bit better?
So a fixed indexed annuity, also known as a FIA in the marketplace, a fixed index annuity says I'm going to put money away just like I would maybe in a MYGA, a multi-year guaranteed annuity. But instead of it with a guaranteed yield to surrender, my yield is going to be based on indexed performance. Don't want to get into the weeds on all the different calculations of indexed performance, but the unique feature with a fixed index annuity is more often than not, you'll have a 0% floor where there is no volatility of potential for loss of the balance of the money you put into the annuity product. There's only the upside potential. The analogy I like to give, Josh, in a fixed index annuity is if the market index hits a home run, the fixed index annuity hits a triple. They do it really well. If the market index strikes out, the fixed index annuity is staying on the playing field and they are walking to first base. So they're still in the game. They haven't really lost anything. But a fixed index annuity is something to look at for those that it fits.
Very good. And I want to, before we briefly dive into pensions, Jay, I do want to say for compliance purposes, guarantees of annuities rely on the financial strength and claims paying ability of the insurance company that issues them. Lifetime payouts may not be a benefit of a base annuity contract, but may be offered through additional purchases of other lifetime benefit riders. The point of that is understand that these are insurance products and you need to look at them carefully, and you want to go with companies that have good strength and a good history of paying these things out, and they're not for everyone. So with that said, Jay, just quickly, I think a lot of times people are surprised or maybe don't realize when they have a pension that often enough annuities are the mechanism to which that pension is paid out. So let's talk about that, because you might have somebody tuning in right now and saying, well, what do I care about annuity? I've got a pension. Well, you may have both. So let's talk about that briefly.
Yeah, and again, if you're listening to this and you do have a pension, you are in the minority of the Americans, but the insurance companies offer these products, making pensions payouts a lot more attractive to the corporate entities around the country that still offer a pension plan. It's more advantageous for them financially to give you a pension payout tied to an annuity product versus just paying you from their general accounts or their retirement planning funds.
Very good. And on that note, one last way that you all can tell if you have an insurance company tied to your pension, kind of a simple rule of thumb test is just do a pension projection and see if there's a insurance company name up on the top of the page that you get. Sometimes you'll see Transamerica, you see other companies like that, and that'll give you an indication that annuity is is one of the options for funding that pension. All right, Jay, so let's dive into our main topic, rising interest rates and how they impact annuities. And I want to set the table this way. low interest rates in broad terms are beneficial to borrowers, right? You can get a mortgage cheaper, you can buy a car cheaper on a loan, things of that nature. What a lot of times people don't necessarily realize, particularly if maybe you're still in the accumulation phase, is low interest rates actually have made it difficult for people seeking guaranteed rates, principal protection, or guaranteed lifetime payouts. And we're going to touch on what do we mean when we say all those words. So set the table this way, Jay. Rising interest rates in general, what kind of impact does that have on the annuities that we listed previously?
So it's a correlation, positive correlation effect. So if we're in a rising interest rate environment, and let's think about the 10-year Treasury yield. You may have heard that on some of your talk shows and some of the radio shows you may listen to. If the 10-year Treasury yield is rising, then we are looking at a rising interest rate environment, which a lot of insurance companies tie their annuity rates to the 10-year Treasury yield, whether it's a MYGA or a deferred income annuity or even that fixed index annuity. Performance inside of that annuity contract could be tied to the 10-year Treasury yield, and that just means when it goes up, so too do the rates. So what we are in a situation, I guess, since 2018, the Fed funds has said, hey, we're going to increase our rates on the borrowing. That has an impact on the interest rates for crediting as well. So when the 10-year Treasury yield goes up, so too do our MYGA rates, so too do our SPIA rates, as well as our indexed rates.
Right. And on that note, so a couple things, Jay. One, again, a very broad statement, very qualified statement I want to say is, in general, in a rising interest rate environment, you have the potential, depending on when you purchase the annuity, of getting a larger lifetime payout of the income that you're receiving. However, Jay, I'm going to kick it back to you. Insurance companies don't necessarily have a hotline to the Fed, right? I mean, maybe some of the big ones are working in conjunction to some degree, but do interest rates, crediting, and things that impact annuities, do they tend to lag the overall interest rate environment?
There is a lag. It depends on the type of product that there's being offered. So MYGA rates and immediate annuity rates will sometimes have a 30 to 60 day lag behind that. And that just means the insurance company wants to maintain or make sure that 10-year Treasury yield is staying above today to 2.25, 2.5. It's approaching, we're time stamping this, it's roughly a little bit above 2.25, and it could be continued to rise because the Fed has said they're going to continue to rise their Fed fund rates. But there's usually going to be anywhere from a 30 to a 60-day lag on the product, whether it's an indexed or a immediate or a guaranteed annuity.
Now, and then let's do one last qualification for those of folks that are looking at purchasing an annuity, because you're hearing all this and you know that the Fed is increasing rates on at least somewhat of a scheduled event. So you're probably thinking to yourself, well, should I just wait to buy the income annuity? Well, that's going to depend on your particular situation. And the one thing that you got to take into consideration is, if I defer buying this annuity, how much payout am I leaving on the table? What are my particular needs for that time period? It's just like trying to time the market. There's really no perfect time because these things are not a direct X equals Y type of equation. There's a lot of moving pieces to it. The main point of this is, in general, rising interest rates tend to increase the payouts of annuity-type products. They do it in a lag environment, and again, it's not like you can just say, okay, Fed just raised the rates here. 60 days from now, I know that I'm going to get a higher payout. That doesn't necessarily work that way because you also have life expectancy tables and a bunch of other moving parts that come into that. So you got to take in consideration the loss of payments and how that applies to your particular situation, because you may give up 2 years of payments that you don't ever get back on the nominal interest rate increase and payout that you get. So that said, Jay, I'm going to give you final word. Anything you want to add to it?
Well, I'd just like to point out that we're starting to see anything from the 3-year MYGA to the 10-year MYGA. Those rates are increasing. Today, again, we don't like to timestamp it, but we need to. March 21st, 2022, we're looking at a 5-year multi-year guaranteed annuity. If an individual has potential of 6-figure balance to contribute, then they're looking at a 3.15 rate yield to surrender. That would be guaranteed by the underlying insurance company. And again, these are just rough figures, and you would ultimately need to do your own research with your own advisor towards those products. But we're looking at above 3% for today, March of 2022.
Yep. Well, I'm going to say final word. The one thing I will tell the listeners, particularly those ones that are pre-retirees, retirees in the retirement red zone, 5 years or less, annuities tend to be large purchases, and they tend to be relatively complicated products, especially with the fixed index. And so the point of that is always get somebody that is qualified, has qualified help, has the expertise to walk you through this, that gives you, the good, the bad, and the ugly, if you will, and shoot you straight on this. Our particular practice, we do deal with fixed income annuities, MIGAs, things like that. We try to do a good job of explaining how those parts work. And then for you other advisors out there listening and agents, I've got Concourse Financial Group and Jay Stubbs on speed dial for helping me walk through these products with these clients. Because again, these tend to be large purchases to produce a guaranteed level of income that can satisfy at least a portion of someone's lifestyle needs in retirement. So, and you all do a great job on that.
We appreciate that.
Yep, very good. Well, listeners, if you would like to continue the conversation related to this annuity discussion, you can call 251-327-2124. If you don't reach me, leave a message, or you can visit gulfcoastfa.com to schedule an appointment, a no obligation appointment. That's Gulf Coast FA, FA is in financialadvisor.com. For those you advisors and individual producers and semi-independent agents out there, hearing what Jay Stubbs and Concourse Financial Groups brings to the table, you can reach him at jstubbs.com. That's JAYSTUBBS.com. So, Jay, another show in the can. We did good. We had a little podcast session studio here in Deep Pride. Many thanks to our producer, Johnny Gwynn. Many thanks to you as always. And as always, a huge shout out to all of you that have joined Jay and I on this journey, and to those of you that are joining us now. Do me a favor, please subscribe on the Apple Podcast app or wherever you get your favorite podcasts. And while you're there, you would be doing us a huge favor if you would rate and review the show. It helps other listeners like you find us. Lastly, if you like the show music, go check out slothracerband.com. That's slothracerband.com. And they're going to take us home now. This has been Every Dollar Counts with Josh and Jay. Advisory services offered through Prime Capital Investment Advisors, LLC, PCIA, a federally registered investment advisor. PCIA, doing business as Prime Capital Wealth Management, PCWM, and Qualified Plan Advisors, QPA. Gulf Coast Financial Advisors is independent of Prime Capital Advisors. Information presented for educational purposes only, is not an offer or solicitation for the sale or purchase of any securities. All investments involve risk, and unless otherwise stated, be sure to consult a tax professional before implementing any tax or investment strategies.